Welcome to TradeNMBI.com. This is John. This report is for the 4th, and well, more of a continuation. We can clearly see it. The orange has remained between the shorts up here in the cyan and the red DOC right here, or D Omega converted, and you can see that we've cascaded below the negative 13.5. Now, obviously, if we get down towards this 20 area, we're likely to see an automatic bounce. The green has already done so, so that could create a little bit of a pivot. I think we saw a little teeny one right there the last time, and this just gets into an oversold that creates a little bit of reaction. Now, obviously, if you're going to get into that oversold, typically you want your orange coming down here below the red to give you some kind of sustained support for it. We had a brief period where that happened, but immediately we ended up with a spider, which is what I call right here, where the legs of it cross over this little triangle body here, little diamond, and that was the DOC spread that really began the decline, and then we looked for orange dipping below into this no man's zone, which sort of, if we filled in the area right here between the cyan and the red, it would give a better kind of indication of that zone that you look for and the disparity between it. Obviously, if the gap is widening and the orange right in the middle of it, you tend to get more of a continuation move. Last time we saw it was like right here, and you can see that it continued until it breaks below one of the key points. Now, shakeout continuing to fall, and you can see it's already turned the additional darker magenta because it's broken below the yellow right here, as well as we've got crossover of the magenta red combination, which is just a little bit longer view of the algorithm. Overall, NQ, likewise, same particular point, has been breaking down a little bit earlier, and that's because the NQ had outperformed. And you can see the NQ is definitely down here on the extreme histogram into that super oversold, which means that you're likely to continue to test the lows on each of these given those days until it gets up. That's where the S&P is not quite as negative. The Dow also similar negative, but producing less of a dip because proportionally it was already lower from its highs. So we're just getting an evening out of the market. None of this is too dramatic. We should start to see fund money come in. The key with that one is going to be whether or not they're selling into it because of around the 5th of the month you start to get the flow, and that may happen ironically right before the election. It's interesting, I pointed out that the downdraft, we've always talked about this from day one with the election, that the general bias for the whole year is to the positive side, but that the built-in factor was for an HRC win. Some of the polls have tightened dramatically, and we're getting a sell-off now. How much of a sell-off? People thought it would be doomsday. No, I pointed out on the Skype chat a little bit earlier that Donald Trump has also selected a former Goldman Sachs partner, so Wall Street's not exactly excluded from either side. So they're comfortable with their situation. Obviously, they're betting big on the top side. I think they have it 80-20 for HRC, and they're still maintaining that even here with 4 days left. So that's still the propensity, and so it's going to just create a bigger upside swing should they get eventually what they want. Now, Euro's been rallying because with the potential weakness of HRC situation, obviously a Trump would cause a very dramatic change in policy, which would certainly impact how the dollar is treated. So the fact that that impact certainly weighs on considerations. Now, the euro got oversold, but also now you have the Brexit situation that just got overturned. That has a direct, little bit more of an impact as far as the euro goes, because keeping Britain inside the EU certainly is going to bolster its general viewpoint of trade and growth. So I think that's more or less Brexit kind of situation, even though it just happened. There's always people in the know a little bit ahead of time, and plus this needed to even out anyway. It had gotten super overdone here. How far did we dip down? It was like minus 22 on that for the DOC, and usually we see an automatic correction at that point, and then we ended up making lower lows on higher extreme, which is typically a little bit of a buy. Doesn't mean it's sustainable, but you can see we've stayed right within the range, which is the 115 to the little over 107.5 range. consistently for quite a bit of time. So no variation in that. And I did mention I would talk about the Fed correlations to some of this and how it impacts in the election and why it becomes significant from a monetary policy standpoint. We'll talk about that as soon as we've gone through the last of the charts here. TLT bonds. With the fact that there was no rate increase, FOMC not going to be, they keep talking about potentially in December. It's unlikely. The no growth policy has been in place for quite some time, and I've gone over before what that looks like and the three tenets that you need to maintain it. And it's exactly what the election really has a huge impact on. USO, like I said, you open up the floodgates to that with massive inventories they have. There's no way those inventories are going to get eased off. They thought they were tightening here going up when the Saudis mentioned that they were going to cut a little bit of production. Not going to help. Not going to help because you can always fill in that supply with the U.S. Shale situation, and that's going to be problematic going for oil all the way for the foreseeable future. Exactly. And gold as a defensive hedge, but more or less starting to rev up a little bit for inflationary purposes. And once we go over the 5K, I'll talk about what that potentially could be. So we ended up with a nice little buy that came down through here as we moved up in the shakeout and had the orange that then dipped below the steel and wasn't overbought. Earlier when it happened and you came down, you had a situation where you were below the shakeout yellow, so you couldn't quite catch the bottom. You could have taken it as an experimental one on the dip, but I prefer when you actually don't have this situation where you've got a rogue shakeout configuration. So it was a little bit later and above the long algo that created the long move. Didn't take long for it to turn around. It wasn't much of a change from there. It was pretty much sideways. Short algo was still leading, and then the breakdown reading came right there, and boom, cascaded lower from there. And even with the most recent buy that took place right over here, it's a pretty modest one. And Cyan still running the chart a little bit lower at this particular point. Got a little overbought as you moved into it. Now you filled all that back in. So nothing too dramatic in the sense that, given the volatility of what's taking place from an election standpoint, you would think that you might see more. I think the swings have been pretty good. Yes, you're seeing the headlines with all of the dramatic talk about longest losing streak. Well, that's just because we've been in a phenomenal run because there just is nowhere else to get yield, and so you're forced to have your money in the market. But I've always talked about this trifecta that the Fed has maintained. The idea of having no growth policies for the last decade allows you to have massive deficits without really busting the budget. And it's required to do a couple of things. You need oil prices low. You need a massive amount of new labor coming in, both unskilled as well as even partially skilled, which is where you're hearing stories about the visa programs and that. And that's designed to keep wage pressure down. So this is a problem. HRC, for all intents and purposes, is going to maintain a similar policy of low to slow growth, which is basically to kind of keep you on the verge of a recession all the time by not allowing growth to get anywhere near that 3%. In fact, we're probably heating up a little more than it should be right now. And while that isn't necessarily great for the citizenry, it definitely allows you to have massive deficits and continue to perpetuate low interest rates. Now, when Donald Trump talks about accelerating the economy, and that becomes a problem for the Fed because at this particular point, you start to move to a 4.5% growth rate, and then you have to have rates rise, and that certainly is going to impact your bonds. It certainly is going to increase yield, which is going to put pressure on the market because if you have yield that's outside a non-risk asset, you're certainly going to take it for part of your portfolio. So the idea of the wealth effect that was being created by an inflating stock market was sort of perpetuating, but it was only creating wealth disparity in a dramatic fashion, which is why you've seen such a change over the last decade. That old claim of the wealthy getting wealthier and the poor getting poorer. Well, this is exactly what that's a result of. Now, if you stimulate the economy too much, which definitely a change in policies could do, you could see some pretty dramatic alterations. You would also see a very strong dollar that would send the euro back to a more effective range, which would be sub $1. The reason for the euro being elevated the way it is the Fed has maintained it a little bit high to help offset some of the low growth ideas. So I think that some of these other countries, actually, with the currency manipulation by the Fed, in the effect of liquidity in that, and you can see the EU started to do that, which caused it to come back a little bit. But the Fed still has control over how much of that takes place, and this has put a lot of pressure on some currencies being overvalued dramatically. And if you start to get growth and you start to have an interest rate rise, you're going to see the pound, you're going to see the euro dropping dramatically, as well as a lot of other currencies. So there's some big implications as to what happens from a policy standpoint and how that impacts budget and what you can do with controlling those budgetary costs. And I said, you can imagine that's a great concern for the Fed, because a budget that's out of control as far as debt payments and that, particularly now that you're at 20 trillion in debt, there are serious implications with that. So it's not as simple as wanting growth versus not. There are broader implications, and some of this is a little bit thick from an economic standpoint, but definitely has real bearing as to what happens going forward here, because a change like that is going to cause something like gold to shoot up to some of those ridiculous levels that you heard people talk about in the 3,000 an ounce and higher. And it definitely could happen in that capacity, because you could see a significant inflation, particularly if you restrict immigration. You could see wage prices skyrocket very quickly, and that would definitely impact growth, inflation on a lot of different levels. And right now you have really a strong grip of the Fed kind of controlling how growth is. It's not really an open free economy. It hasn't been since 2008 really, or when the Fed really became strong involved in 2009. You pretty much had a controlled market, which like it or not, that's just the reality of it, and you can't fight the Fed. And this is what I've said for many years. It's like, yes, while it may be out of the norm and not acceptable, you really can't fight it, because they have unlimited control over monetary policy, and they've really exercised a lot with the whole asset buying, and they've got quite a significant balance sheet that would have to be dealt with. And while it is paper at this particular point, at some point on the monetary easing could physically end up having to move into the economy, and if that starts to happen, then you have massive inflation. Right now, pretty much this electronic money that's been created has been forced into either the market in the form of asset appreciation here, and or additional bond purchases. But if that actually starts to move into real formation, meaning people putting it into businesses and the economy in the form of actually creating growth in that, then that money gets materialized. And if that happens, you're going to see a significant spike in inflation, which is going to cause gold to just go through the roof. So there's some really important implications, at least for us, for market viewers, irrespective of who you like or that. It isn't even relevant to our discussion here. It's just merely about what it means as far as market effects, and we have to pay attention to that, because that will certainly have a bias for us going forward as to how we see things. So yes, you could see a significant pressure on the market downward with a Donald Trump election, because he would definitely be putting pressure on economic growth to rise, and that has a whole series of complications and difficulties that go with it. So these are the realities. I thought I would just give you a little clarity on some of those ideas. I know I've gone long. As always, though, continue to look for me on the Skype chat. Trade well.